All right, what topic do we have today?
Leases.
Leases. In 3 minutes or less.
Yep.
Okie dokie. Let's do it. I think we got it. We got this. Let's do it. ASC 842 leases. The big deal with leases is if a contract is in the scope of ASC 842, it is going on the balance sheet. So it's the most important question we have to answer. In order for a contract to be a lease under ASC 842, there are 2 criteria that need to be met. First, we need an identified asset. Second, we need to have control over the use of that identified asset. If we meet both of those criteria, unless it meets the short-term lease exemption, it is a lease. What does that mean? At the lease commencement date, we're going to record the following journal entry. We're going to debit an ROU asset and we're going to credit a lease liability. That lease liability is the present value of the remaining lease payments. How do we know what that is? We need a few key inputs. One is the lease term. The lease term is going to include the non-cancelable lease term at a minimum, but then there are other considerations as well for potential renewals or terminations. Once we know the term, we look to the lease payments over that term. The lease payments are, at a minimum, the fixed lease payments, but could also include variable lease payments based on an index or rate or other items based on the guidance. Once we know the term and the payments over the term, we're ready to discount it back using a discount rate. That discount rate could be the rate implicit in the lease, if we know it. If not, it could be the incremental borrowing rate of the lessee, or if it's a private entity, they could elect to use the risk-free rate as a practical expedient. Once we've gone through that whole process, we have the lease liability that we record at lease commencement. The ROU asset starts with that lease liability, but we could also capitalize things like initial direct costs or prepaid lease payments. To determine the subsequent accounting, we need to know the classification of the lease. There are 2 potential classifications. A finance lease is one that meets at least one of any 5 criteria. If we meet 0 of those criteria, none of the criteria, only then can it be classified as an operating lease. For a finance lease, the subsequent accounting is pretty straightforward. We are going to accrete the lease liability using the effective interest rate method. We are going to amortize the ROU asset, and we'll record lease payments. For an operating lease, it gets a little bit more complicated. We'll still recognize lease payments, like we usually do. We still have a lease liability we need to accrete using the effective interest rate method. We still have an ROU asset we need to amortize. However, the difference is, instead of recognizing interest expense and amortization expense separately, we're now going to combine the 2 and instead recognize something that we call lease expense, which is going to be determined by figuring out all the lease payments and initial direct cost and dividing it by the lease term. There's plenty of other considerations for leases, including modifications, impairment of that asset we recorded, and tons of other fun stuff. So if you need a little bit more guidance on accounting for leases under ASC 842, I definitely recommend that you check out our Leases collection on the Revolution. Thanks. Using one of 3, and I just want to start that over. I feel like that was